Lauren earned $92,000 annually managing client accounts. Yet when she approached Wells Fargo requesting $30,000 for her side venture, everything she prepared suddenly meant nothing. She'd rehearsed her entire presentation, 2 clients already committed, paying her $4,000 monthly combined. Her projections demonstrated she'd hit $170,000 within 20 months if she transitioned full-time. The capital would bridge her transition expenses and cover essential equipment. The banker smiled, nodded appropriately, then delivered requirements she couldn't possibly meet. 24 months of business tax documentation, audited financials, collateral exceeding $40,000. She possessed none of these because her venture was brand new. She lacked $40,000 in collateral. Denied. Lauren departed feeling foolish, like she'd completely misread reality's operating manual. 4 weeks passed. That identical institution mailed her a pre-qualified vehicle financing offer, $42,000 at 5.8%. Zero business strategy required, no collateral demanded, just her tax forms proving her $92,000 income. They'd place her in a vehicle immediately. That vehicle would depreciate $18,000 the instant she left the dealership. The business capital would have doubled her earnings. Yet the institution approved the depreciating asset and rejected the income-generating opportunity. I'm Bobby, and I dedicated 9 months discovering how financial institutions trap successful earners, regardless of their compensation levels. If you've sensed your paycheck functions as an invisible prison or suspected that financial guidance from your institution is actually sophisticated marketing, hit that subscribe button and give this video a thumbs up if this resonates with you. What I'm revealing isn't about improved budgeting or increased savings. It's about how the infrastructure punishes entrepreneurial thinking and rewards employment stability, and why rejecting institutional narratives remains your only path toward genuine, unlimited prosperity. Here's what Lauren missed when she entered that branch. Financial institutions don't assess your capabilities, they assess your consistency. Requesting business capital means asking them to gamble on your future possibilities. That represents uncertainty. Requesting vehicle financing means presenting your W-2 form. You maintain employment, you receive regular compensation, you answer to someone issuing payments bi-weekly. That's a locked-in payment pipeline for 72 months. Here's the truly disturbing component. They're not merely calculating repayment probability, they're calculating whether you'll remain positioned where continued payments become mandatory. An entrepreneur who thrives achieves financial autonomy. An employee carrying vehicle debt maintains financial dependency. One client eventually eliminates their institutional need. The other client requires institutional services indefinitely. According to Federal Reserve data from New York, total American consumer obligations reached $17.7 trillion in 2024. Nearly all that obligation connects directly to employment income. Your housing debt calculates from your earnings, your vehicle financing approves based on your earnings, your available credit determines from your earnings. The complete infrastructure assumes one principle: your employment compensation represents your financial capacity maximum. This assumption isn't coincidental, it's deliberately architected. Consider how borrowing products market themselves to you. You never observe advertisements stating, "Finance your entrepreneurial launch." You observe advertisements proclaiming, "You've earned this vehicle, you deserve this getaway, reward yourself." Every communication links your borrowing to your present circumstances, your current identity, your existing income bracket. The capital you can access stays perfectly calibrated, maintaining comfort at your present earning level while guaranteeing insufficient surplus for escape. Those pre-qualified limit increases arrive predictably whenever you receive promotions. The infrastructure ensures that regardless of earning increases, you're perpetually stretched to your income's supporting edge. You're perpetually one missed payment from crisis, because that's when you're most profitable to them. Not when you're prosperous, when you're leveraged. Now, you're probably thinking, okay, Bobby, but that's standard lending methodology. Institutions must verify repayment capability. Except here's what completely destroys that reasoning. That identical institution demanding 24 months of documentation before approving $30,000 for business purposes will authorize $80,000 in revolving credit based on a 12-minute application. They'll extend a home equity credit line for $120,000 you can utilize for literally anything with zero supervision. They'll finance watercraft, recreational vehicles, elaborate ceremonies. The barrier accessing consumption debt is virtually non-existent. The barrier accessing wealth generation capital is intentionally impossible unless you already possess wealth. Lauren could have exited that institution with $85,000 in obligations that afternoon, zero questions, zero business strategy necessary, yet $30,000 to double her income, unattainable. The infrastructure isn't designed assessing genuine risk, it's designed funding consumption and blocking prosperity creation, because consumption maintains your treadmill position. Prosperity creation permits stepping off. Let me demonstrate exactly how this manifests with actual figures. Suppose you earn $100,000 annually. Your institution will gladly extend housing debt around $350,000. They'll finance a vehicle for $40,000. They'll provide revolving credit totaling perhaps $50,000 in limits. You can access over $400,000 in obligations, all structured around your present compensation. Now suppose you want $55,000 to launch a venture. That $55,000 could realistically generate additional $6,000 monthly within 12 months if executed properly. That's $72,000 annual income. Your $100,000 compensation just became $172,000. But the institution won't provide that $55,000. They'll provide $400,000 for housing and vehicles and credit cards, none generating income, all losing value. They won't provide $55,000 for the singular thing that could actually transform your financial trajectory. And here's the component that should infuriate you. It's not because the venture is dangerous, it's because the venture is excessively likely to succeed. If you generate $6,000 monthly, you just shattered your compensation ceiling. You just stopped being an employee who must finance their existence. You just became someone constructing prosperity. And prosperous individuals don't require institutions the way leveraged individuals do. The psychological conditioning runs so profoundly that most individuals never even submit the business application. They examine their compensation and think, this represents my value, this defines my affordability, this is my maximum. Lauren nearly avoided the institution entirely because part of her mind was already insisting she didn't merit the capital, that she wasn't sufficiently established. She'd internalized the ceiling before the institution even rejected her. That's the truly brilliant component of the infrastructure. It doesn't just prevent you from accessing prosperity-building capital, it conditions you to stop requesting. You accept that your compensation is your boundary. You optimize your existence around monthly obligations you can manage based on present earnings. You begin thinking in terms of, can I manage the payment, instead of, will this construct wealth? Once you're thinking that way, the institution has succeeded, because now you're administering your obligation burden instead of constructing assets. The institution has successfully redirected all your financial energy into optimizing within the cage instead of escaping it. Let me share what happened to Lauren after the rejection. She didn't accept the vehicle financing. She maintained her aging Honda. She continued her employment and developed her consulting practice during the evenings and weekends. It required 24 months instead of 8 months, but she eventually transitioned full-time. She's currently earning $260,000 annually. Her venture employs 5 people. She has equity in something she constructed. And recently, that identical institution that denied her business capital contacted her offering portfolio management services. They want to help her invest her capital now that she doesn't need them, now that she constructed the prosperity without them. They rejected her when it would have mattered. They're accepting now that it's meaningless. And Lauren told them to disappear. The complete financial infrastructure is structured maintaining your income predictable and your prosperity limited. Your compensation is not your capability, it's your current price for your time. But institutions want you believing it's your ceiling. They want you constructing your complete financial existence around that figure. They want you borrowing up to the boundary of what that figure supports. Because as long as you're thinking that way, you're thinking like an employee. You're thinking like someone who must finance their existence. And individuals who must finance their existence need institutions. Individuals who possess assets, who generate cash flow, who construct equity, they utilize institutions, but they don't need them. There's a distinction, and the complete lending infrastructure is designed ensuring you never discover that. Right now, you probably consider yourself responsible because you only borrow what you can manage based on your compensation. You calculate carefully, you ensure the payment fits your budget. But what if being responsible means refusing to let your present income define your future prosperity? What if the intelligent choice is stopping asking what you can manage and starting asking what you should possess? The institutions want you focused on manageability. Can you manage this housing? Can you manage this vehicle? Manageability is about remaining within your present boundaries. Ownership is about shattering through them. Every dollar you spend on interest is a dollar that could have purchased equity. According to 2023 Federal Reserve analysis, the median American household will pay approximately $460,000 in interest over their lifetime. That is capital that went to institutions instead of constructing prosperity. So here is what you do. First, stop asking what you can manage and start asking what you should possess. Make a list of assets that generate cash flow or appreciate in value. Then compare that to your present obligation burden. How much are you paying monthly for things that lose value? That figure is your prosperity gap. Second, automate a portion of your income toward asset acquisition before you even observe it. Automate 25% toward prosperity. Let your lifestyle adjust around what remains. Third, every time an institution offers you obligations, ask yourself, does this make the institution more capital, or
The answer is always obvious once you ask the question. Fourth, refuse to let your present compensation define your financial ceiling. You are not valued at what your employer pays you. You are valued at what you can create, what you can construct, what you can possess. Your compensation is just your current agreement with one purchaser of your time. The ceiling only exists as long as you believe it. Lauren almost followed the guidelines. She almost accepted the vehicle financing because the institution approved and it felt validating to be qualified for something. She almost accepted that her $92,000 compensation was her maximum. She almost remained an employee permanently because that is what the infrastructure wanted. But something in her refused. She recognized the cage. She recognized that the institution was offering her exactly the kind of obligation that would maintain her trapped, and she chose differently. Not because she was more intelligent or more courageous, but because she stopped believing that her compensation defined her value. She stopped asking what she could manage and started asking what she should construct, and now she's liberated. Not because she earns more capital, but because she possesses what she constructed. She has equity, she has options, she has prosperity that exists independently of any employer or any institution. The ceiling only existed as long as you believed it. You are not an employee trying to manage your existence. You are a prosperity builder who has been systematically taught to think limited. The institutions need you to keep thinking limited. Your compensation is not your ceiling. It is just the current price of your time. Stop selling it inexpensively. Stop financing your present with your future. Stop letting organizations that profit from your obligations convince you that responsible means predictable. You are valued more than your paycheck. You are capable of constructing more than your budget permits. The ceiling is a fabrication, and you just saw through it. If this transformed something, smash that like button and subscribe to Bob Investify. I'll see you in the next one.